Good day, and welcome to the D-Marq-AnalyticS channel. In this week's video, we will look into an interesting topic: behavioral economics of panic, decoding institutional sell signals using sentiment algorithms. Introduction: why panic is predictable. When markets panic, most investors see chaos. But if you understand behavioral economics and sentiment algorithms, panic becomes a signal, not a threat. Institutions, despite their sophistication, are not immune to fear. In fact, their size makes them more predictable when fear overrides valuation models. Today, we're going to bypass traditional metrics and weaponize sentiment analytics to decode the exact moment institutional fear triggers liquidity cascades. You'll learn how asymmetric risk forms, how herd mentality amplifies volatility, and how to position yourself before the market realizes it overreacted. By the end of this video, you'll understand how to identify institutional sell signals in real time. Section 1. The behavioral economics of institutional fear. 1.1. Institutions are not rational, they are incentive-driven. Portfolio managers are judged quarterly, not philosophically. Risk officers override CIOs when volatility spikes. Incentive structures reward not being wrong alone, which fuels herd behavior. 1.2. Loss aversion at scale. Kahneman and Tversky showed humans fear losses twice as much as they value gains. Institutions experience this asymmetry multiplied by billions. When losses accelerate, the mandate shifts from maximize return to minimize career risk. 1.3. The panic feedback loop. A small drawdown triggers VAR breaches, forces de-risking, accelerates selling, triggers more breaches. This is not valuation-driven, it's protocol-driven panic. If fear is predictable, then the question becomes, how do we detect it before the cascade begins? That's where sentiment algorithms come in. Section 2. Weaponizing sentiment algorithms against panic. 2.1. Why sentiment beats fundamentals during stress. During panic, fundamentals become irrelevant. Price action is driven by liquidity needs, forced selling, margin calls, ETF redemptions, systematic deleveraging. Sentiment algorithms detect these shifts before they appear in price. 2.2. The three sentiment streams that matter. First, news sentiment velocity. Not the news itself, but the rate of negative language acceleration. Institutions react to velocity, not content. Second, social sentiment divergence. Retail panic spikes earlier than institutional panic. When retail fear diverges from price action, institutions are preparing to sell. Third, order flow sentiment. Dark pool prints, options skew, put-call ratio dislocations. These reveal institutional hedging before the public sees it. 2.3. The algorithmic panic signature. A true institutional panic event shows sharp negative sentiment velocity, rising put skew, increasing dark pool sell prints. This is the panic fingerprint. Sentiment alone isn't enough. We need to understand the asymmetric risk that panic creates. Section 3. Mapping asymmetric risk. During liquidity cascades. 3.1. Asymmetry is born from forced behavior. When institutions must sell, price becomes irrelevant. This creates downside overshoots, liquidity vacuums, mispriced assets, temporary dislocations. These are opportunities if you know where to look. 3.2. The anatomy of a liquidity cascade. First, trigger. A macro shock or unexpected event. Second, propagation. Systematic funds delever. Third, amplification. ETFs and passive flows accelerate selling. Fourth, capitulation. Retail panic joins. Fifth, exhaustion. Sellers run out of inventory. Sixth, reversal. Price snaps back violently. 3.3. Identifying the exhaustion point. This is where asymmetric opportunity peaks. Look for sentiment bottoming while price still falls, volatility peaking, liquidity depth stabilizing. Once you can map the cascade, the next step is decoding the herd mentality that fuels it. Section 4. Herd mentality, the hidden engine behind institutional panic. 4.1. Herding is a career survival strategy. Institutions don't want to be wrong alone, so they sell when others sell, hedge when others hedge, de-risk when others de-risk. This creates synchronized behavior. 4.2. The illusion of independent decision-making. Despite having quant models, risk dashboards, macro teams, proprietary data, most institutions react to the same signals. VIX spikes, credit spreads widening, treasury yields collapsing, correlated cross-asset volatility. 4.3. Herding creates predictable patterns. When everyone reacts to the same triggers, the market becomes more fragile, more correlated, more predictable. This predictability is your edge. Now that we understand the psychology and the mechanics, let's talk about execution. How to enter when everyone else is panicking. Section 5. Strategic entry. Executing while the market loses control. 5.1. The goal is not to catch the bottom. The goal is to enter when panic is peaking, when forced selling is nearly exhausted, when sentiment begins to stabilize. Watch for institutional hedging patterns. Phase 2. Confirmation. Sentiment bottoms, volatility peaks, selling pressure slows. Phase 3. Execution. Scaling gradually, target high-quality assets, avoid leverage, use asymmetric setups. 5.3. Why this works? Because you're not fighting institutions, you're front-running their return to rationality. When panic fades, institutions must rebuild positions, reduce hedges, re-enter risk assets. This creates a powerful tailwind. Conclusion. Turning panic into predictive power. Institutional panic is not random. It's structured, predictable, and algorithmically detectable. By combining behavioral economics, sentiment analytics, liquidity mapping, herd psychology, you gain the ability to identify the exact moment fear overrides valuation and position yourself strategically while the broader market succumbs to chaos. This is how you stop reacting to markets and start decoding them. If you found this week's topic helpful in any way, kindly hit the like button and share this video with anyone you think might find it interesting. Please feel free to subscribe if you'd like. We want to thank you all for staying till the end, and we wish you all a wonderful day ahead.